Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is active investing versus passive investing. Now, over the last decade, active investing has come up short, way short. Passive investing has beaten the hell out of active investing. I think that's about to change. That's what I want to talk about today. I think that's about to change. I think passive investing is going to take a back seat going forward here to active investing. Now, passive investing, just so we start off on the same footing, passive investing is when you get access to a particular segment of the market or the entire market, right? You have passive ETFs that give you exposure to the entire U.S. stock market. Passive ETFs that give you exposure to the entire U.S. bond market. And a whole host of other ETFs to give you segments to microcosms of the market, right? Little sleeves of the market. All right, so passive investing is not designed to outperform anything. It's designed to give you access, exposure to a particular segment of the market. Active investing, however, is designed to beat passive investing. They're passive investing cohorts or counterparts. Right? Active investing is designed to beat their benchmarks. Right? That's where the alpha comes from. The excess returns comes from that category. So let's start off here by taking a look at the historical record. And again, I caution you, this has all been one-sided. This is from a CNBC article about about a year ago. All right, you can see it's March of 2019. What we see here is over the for the ninth consecutive year, most active large cap U.S. managers, right, have underperformed the passive S&P 500 for the ninth consecutive year. Now look at this. For the last 10 years, 85% of S&P 500 active managers have come up short. 85%. Over the last 15 years, that number's 92%. Wow. Talk about getting beat. That is ugly. But I think that's all about to change. I think that's all about to change. Now you're probably thinking to yourself, "That man, don't pee on my leg and tell me it's raining." Well, that's a fair thought. That's a fair thought. But I think you'll understand when we walk through the reasons why there is likely to be a shift going forward. Now, first, let's talk about the results of the past. Why has passive been so dominant? Well, one is we're coming off the longest expansion period in history. And it's much easier for active managers to add value in down markets than it is up markets, right? That's what the scientific literature tells us. And we just haven't had many down markets, right? But that was a bull market. Now we're in a bear market, all right? That's point one to consider. The second point is we're getting better at measuring performance. What we thought was alpha in the past, we know today is not, right? We're able to call bullshit on some of the tricks of the past. Now, what am I talking about here? A typical example would be you'd have a lot of large cap active S&P managers that would have a persistent small cap tilt or a value tilt. All right, so think about this. So you might be an S&P 500 manager and you take 10% of your portfolio and you invest it in the S&P 400, right? The mid cap index. So you got 90% of the 500 and 10% of the mid caps. That slight tilt could have been enough to generate alpha, to generate excess returns, and we think it's due to alpha. But now we know, now we're getting better. Now we know that all that active manager was doing was mixing two passive funds together. That's all they were doing. So if you wanted a persistent mid-cap tilt, put it on yourself. Why not? All right, so that's the second reason I think a lot of active managers that underperform their passive. So let's get into the point of the day. Why are things going to change? Why are things going to change? Well, the important criteria going forward, the formula for success, I think, is going to be the strength of the balance sheet. That's a big difference between the bull market and bear market. In the bull market, you can get away with a lot of shit you can't get away with in the bear market. Now, what I'm talking about is again, strength of the balance sheet. The firms that can generate free cash flow in a bear market or in a recessionary environment. Firms that can generate cash flow above their operating expense. Firms that can manage their debt burdens, that aren't overwhelmed by their debt burdens. Those are the firms that are going to succeed. Now, today we have something like 55-60% of all investment grade bonds are in the lowest investment grade category. They're just a notch below the high yield or junk status. And when we go into this slowdown, when we go into this bear market, a lot of these companies are going to be downgraded. Right? What does that mean? Why is that important? Well, their cost of capital goes up significantly. And their ability to issue long-term debt goes away, right? High yield, you're always in the market because the short-term debt, you got to completely, you got to consistently be rolling forward. So your ability to raise funds, raise them at attractive pricing, and raise them at the terms that you're used to, all go away, right? The rules of the game change. So that's obviously going to affect profit margins. It's going to affect the way of doing business. It's ultimately going to affect earnings. When it affects earnings, of course, those stock prices underperform. And again, we're talking about a large chunk of the S&P 500. So while you were able to just hold the S&P 500 in the past and sing Kumbaya, that formula worked in the past. It's not going to work in the future, I don't believe. You have to be much more targeted. Focus on those firms that are actually doing a good job at managing their balance sheet. That's going to be the easiest way to generate excess returns. All right, so that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed this. May your beer be colder than the company you keep. We'll talk again soon. Thank you.